You're about to watch your neighbor lose their house. Not because they're irresponsible, not because they made bad choices, but because they believe the lie everyone's been selling for the last 4 years. Right now, as I'm talking to you, there's a 12 trillion time bomb sitting in the American housing market. And the fuse, it's already burning. Here's the number that should terrify you: 67%. That's how much of the average American's net worth is locked inside their home, one asset. All your eggs, one basket. And that basket is about to get dropped off a cliff. I'm going to show you something in the next 20 minutes that you won't see on the news. Not because it's secret, because it's too obvious. The pattern has played out 3 times in the last century, and right now, frame by frame, it's happening again. The Treasury just absorbed $23 trillion in mortgage-backed securities in 6 months. J.P. Morgan Chase sold off 40% of their residential mortgage holdings in Q3 of 24. And in November, Deutsche Bank quietly announced $1.2 billion in losses tied to real estate derivatives. These aren't random events. They're choreographed exits. The smart money is already gone, and they left you holding the bag. By the time I'm done, you'll see exactly how this machine works. You'll recognize which stage we're in, and you'll understand why 40 million people, maybe you, are about to discover that your biggest asset is actually your biggest liability. Let's start with how the trap works. Every financial collapse follows the same blueprint. I call it the leverage ladder. 4 stages, same sequence every single time. Stage 1 is the foundation. This is where everyone feels wealthy. Asset prices climb month after month. Credit flows like water from a broken pipe. Your neighbor refinances to buy a boat. Your cousin with a 590 credit score gets approved for a $400,000 mortgage. Nobody questions it because everyone's winning. During 2021 and 2022, U.S. mortgage debt jumped by $21 trillion. That's not growth. That's leverage, borrowed optimism. And here's the thing about borrowed optimism. Eventually, someone wants their money back. Stage 2 is the trap. This is where it gets interesting. The general public is still celebrating. Prices are still rising. But if you know where to look, you'll see the insiders heading for the exits. Check SEC filings from the Q4 of 2024. CEOs from the top 12 mortgage lenders sold $487 million worth of their own company stock. Not diversifying, not retiring, selling. They're reading the same data you can access. They just know what it means. Interest rates are high, but prices haven't corrected. That gap, that's the trap. Think of it like scissors. The blades are spreading apart and your neck is right in the middle. Stage 3 is the trigger. Something breaks. It's never the thing everyone's watching. In 2008, it was subprime mortgages, loans so small that Fed Chairman Ben Bernanke said they were contained. In 1929, it was margin debt that nobody thought could crash the entire economy. The trigger is always something the experts dismiss. Too small to matter, too isolated to spread until overnight. It's the only thing that matters. In stage 4, that's the cascade. This is where time compresses. What took 10 years to build unwinds in 10 weeks, forced selling margin calls. Liquidity just vanishes like water down a drain. Your house isn't worth what Zillow says anymore. It's worth what someone will pay when everyone's selling at once. And what someone will pay is a lot less than you think. Now, here's where it gets wild. This isn't theory. This exact sequence has played out 3 times in modern history. And each time millions of people stood there saying, "It can't happen to me. Let me show you." Everyone knows about the stock market crash of 1929, Black Tuesday. Bankers jumping out of windows, bread lines stretching for blocks. But here's what they don't teach you in school. The crash didn't start on Wall Street. It started in Florida. Real estate 3 years earlier in 1926. Picture this. Miami in the mid-1920s. Land speculation has gone completely insane. People are buying swampland plots, sight unseen. Developers are selling prime beachfront property through newspaper ads to buyers in New York and Chicago who have never even visited Florida. The scheme is beautiful in its simplicity. You put 10% down on a piece of land, flip it to the next speculator before your next payment is due. Everyone's making money. Everyone's a genius. Then, in September 1926, a Category 4 hurricane slams into Miami. Suddenly, people actually go look at the land they bought and they discover something inconvenient. Half of it is literally underwater. Not because of the hurricane. It was always underwater. It's swampland. It always has been. The bottom falls out. Overnight, $1 billion in real estate value evaporates in 1926. That's about $18 billion in today's money gone. But here's the part that matters. Nobody connected the dots. Everyone said, "That's just Florida. Regional problem. The national economy is fine." Except it wasn't fine. Those Florida land deals had been financed by rural banks across the country. When the land became worthless, those banks started failing. By 1929, over 600 banks had already collapsed before the stock market crashed, before anyone panicked. The stock market crash on Black Tuesday wasn't the cause of the depression. It was the symptom. The real estate debt had already spread through the financial system like poison in the bloodstream. The stock crash was